This is the last video I'm going to do for revision, and it's on financial statements. Please remember that financial statements, the question on that forms the biggest part of your paper 1 exam. So it's very important that you do well in this section, in this question. The other thing you must remember, please, is to follow a set method. The first thing you're going to do is fill in your opening balances. Once you've done that, you're going to do the year-end adjustments, and remember for that, do your double entry, and then lastly, you're going to add up. In this activity, I haven't wasted time adding up, because all of you are quite capable of doing that. So I rather spend more time going through the adjustments than on simply adding up the totals. Okay, they give you some balances and totals in the books of Starstruck Sports. They tell you that the business sells sports equipment and also repairs sports equipment for which a fee is charged. When you do a job for somebody, the amount of money you earn from that is called fee income, and then the markup used on all stock is 100% on cost. And you're required to do the income statement and selected notes to the financial statements. There's going to be quite a bit of scrolling up and down here as we work through the adjustments and going to the answers, so please bear with me. And then they do tell you that some totals are not required, and these are indicated as XXX. So if you were doing the adding up, do not add up those totals. Okay, number 1, all necessary totals with the exception of the following have been entered on the answer sheets for you. Okay, let's go through those. Interest on loan. Interest on loan is interest expense. Whenever you're not doing the note for interest, you must show your workings. So that interest on loan figure will get recorded here, and the interest on fixed deposit, which was next, will get recorded under under interest income. Okay, then we have fixed deposit. We're not going to do that. We have loan, which we don't have to do either. Then we have debtors allowances. Debtors allowances, remember, you always subtract from sales. So your sales will decrease by that debtors allowance figure because you have no longer made that sale. Then we have interest on current account and discount allowed. Discount allowed is a normal expense. So you'll need to write that in there. And interest on current account, the 80 Rand, is interest income. Alright, and then just to show you the notes we're going to be doing, it's inventory, receivables, cash, and payables. So you need to bear that in mind when you're doing the adjustments, because anything that affects those you'll need to do the double entry for. Okay, the first adjustment. A credit note was issued to a credit customer who had been overcharged by 80 Rand on repairs to his cricket bat and who had returned a hockey stick which cracked the first time he used it. This cost the business 350 Rand. The hockey stick was subsequently returned and their credit note was received and no interest had been made. So we need to record a lot of things here. The first thing we need to do is that 80 Rand overcharge. If you've overcharged a customer, you're going to need to decrease fee income and then decrease the amount that the debtors owe to the business, the 80 Rand. Then the hockey stick that was returned cost the business 350. So cost of sales will go down by 350 and 100% markup means sales will go down by 700. You are receiving that stock back, so you're going to add to trading stock the cost price and minus from debtors the selling price. And then because we are returning that hockey stick, you're going to have to minus it from trading stock. Some people say, why do you have to do this if they cancel out? You would have filled in 2 source documents for this entry, one for the credit note issued and one for the credit note received, so therefore they would have to be shown separately in your journals and in your ledger and thus in your financial statements. And then creditors, we owe less money if we return. Okay, the next one. Provide for outstanding interest on fixed deposit at 9% per annum. Interest is not capitalized and 10,000 Rand of the fixed deposit will mature on the 31st of May. Okay, let's start with the interest first. They say 9%. So you're going to take that 18,000 and you're going to multiply by 9%. That 1620 represents the amount that you should have received for the year. But do you remember that interest income had a total of 500? That 500 has already been received. Therefore, the accrued amount is only going to be the 1,120. A common mistake here is for pupils to add the 1620 up here. That's not going to be correct, because then you're going to say the interest should have been 500 plus 1620, which it is not. You've just worked out for the year that is 1620. And then the double entry for that is income accrued. That's money owed to us, so it's part of your receivables, just the 1120. And then they say 10,000 Rand of the fixed deposit is going to mature. A financial asset, your fixed assets, so your fixed deposits rather, those mature in more than a year. So if any part of the fixed deposit is going to mature within a year, you need to record that under your cash and cash equivalents. So the fixed deposit that's going to mature within a year is this 10,000 here. So financial assets would decrease and your cash and cash equivalents would increase. Right, the next one. Provide for outstanding interest on loan at 18% per annum. The loan had been decreased by 20,000 on the 31st of August, and the repayment had been recorded, and this is an annual payment. Okay, if you have a look here, this loan figure is after you've paid back the 20,000, because that 20,000 has been recorded. So in other words, to start off the year, you would have owed 120,000. And if you count the number of months, okay, it's half a year, it's 6 months. So we've had 120,000 times 18% for 6 months, and you've got 10,800. And then for the other 6 months, you only owed 100,000. For those 6 months there, gives you 9,000. If you add those two together, you get 19,800. Don't forget to check, have we paid any of that 19,800? And yes, we have. We've already paid 16,500, so therefore only 3,300 is still due. So you're going to add the amount that is still due. In this column here, this answer column, you must always get the correct income and the correct expense for the current financial year. Okay, and then under here you will put your, oh sorry, I think they said interest is capitalized here. Just check. Okay, interest is capitalized. That means it goes to your loan, so you would add that to your loan. Because this is an annual payment, it means that 20,000 Rand, we're going to make another 20,000 Rand payment within a year's time. Your definition for your non-current liabilities is anything that takes more than a year to pay back. Current liabilities, on the other hand, take less than a year to pay back. So of that full loan of 100,000, 20,000 Rand no longer fits the criteria for a non-current liability. So we're going to move it under trade and other payables here as a current portion of loan. Often, my pupils forget this 20,000. They seem to just do the interest and move on. Don't forget, if there's a part of the loan that has to be paid within a year, it must come as current portion. Okay, moving on. Rent for February is still outstanding. This is a nice, easy one. Okay, if rent for February is outstanding, you've only got rent for 11 months. So you've only received rent for 11 months. That's a 33,000. You should have over here received rent for 12 months. So 33,000 divided by 11 is 3,000 Rand that you are owed. So you add to rent income, and the double entry for that will be income accrued, 3,000. Now simple one. The next one. A customer had left his treadmill at the store for repairs and was charged 1,400 Rand for repairs which he paid on the 20th of February. The repairs will, however, only be done during March. So in other words, for this one, we've received fee income, but we haven't done the work yet. So you need to decrease fee income, and the double entry for that is deferred income. We owe that person the service. In other words, we are going to fix his treadmill for him. So that is income that you've received in advance from him. He's already paid you, but you haven't done the job yet. You can call this deferred income, income received in advance. Okay, then the bank statement reflected. Now, as soon as you see bank statement, one of the accounts that's going to change is bank. So we've got bank charges and we've got interest on overdraft. The bank charges will increase. They told you it was sundry expenses, and interest on overdraft is interest expense. Both those amounts will get subtracted from your bank figure, 85 Rand and 185 Rand. Okay, the telephone account for February is still due. If it's still due, you haven't paid enough. So you're going to add the telephone account for February. They also told you that that was sundry expenses, and then expenses accrued will increase with that 850. Okay, the next one. According to stock taking, trading stock is valued at 3,000 Rand less than the balance in the stock account in the ledger. So we counted the stock and it was 3,000 Rand less than what the balance said it should be. So that is a stock deficit, which is an expense. Don't forget to write this in here. Okay, often people forget to put it in there because there's no opening total. So you need to record the stock deficit as an expense and then decrease trading stock. In other words, when you add up this bracket, this amount here will be the amount of trading stock that you've got on hand according to stock taking. And then we also had unused stationery, I think it was. So that's going to be consumable stores on hand. Let's just check what it was for. Yes, stationery unused at the end of the year costs 550. Ask yourself the question, when am I going to use that stationery? And if you've got it on hand on the 20th of February, you're only going to use it next year. In other words, you bought more stationery than you've actually used, so the unused portion will get subtracted here. That's the 1,500. Don't forget, the amount that comes in here for stationery is the stationery that was actually used. Right, then insurance, that other one was supposed to be the 550, and I can see here that I've actually put it under sundry expenses. In the meantime, it should have come under stationery, the 550. I thought stationery was part of sundry expenses for some reason. Okay, so that goes under stationery. You subtract what's not used so that you end up with what was actually used over here. Apologies for that error. Right, and then insurance including under sundry expenses includes a 6-month premium of 1,800 paid on the 1st of February. So you paid 1,800 Rand for 6 months. If you take 1,800 divided by 6, you get 300. And the only month that must be included here is the 1st of February, the month of February. So therefore the other 1,500 has been paid in advance. Okay, so sundry expenses needs to decrease by 1,500, and your double entry for that is prepaid expenses. We have paid for something in advance. The insurance company owes us the cover for that insurance that we've already paid for. Okay, and then the last one, provide for depreciation on equipment, 12% per annum cost. Take into consideration that new equipment costing 15,000 Rand was bought and paid for by EFT on the 1st of February, and this had not been recorded. In other words, this equipment total doesn't include the new one. So that equipment total you will have for the whole year, and this 15,000 here you'll only have for 1 month. So therefore you're going to take the 120,000 at 12% for the year, plus the 15,000 at 12% times 1 over 12 because you bought on the 1st of February, and that will get recorded as depreciation up here. Show those two calculations separately, just in case you count your number of months incorrectly, and then you'll at least get part marks for the number that you did get correct. And then because that purchase hadn't been recorded, you need to record the purchase as well. Okay, so bank is going to go down and your vehicles, equipment, whatever it was, I think it was equipment, would increase. So in your fixed asset note, under additions at cost, you would have 15,000 Rand. Okay, then the last thing you would need to do here now, and this is where you get all your method marks. So what I'm trying to tell you here is make sure you add up. If you get to adjustments that you can't do, rather leave them out. Don't spend time on something you can't do. Let's say that this 1400 Rand was a difficult calculation. Rather leave it out because you'll lose 1 or 2 marks with that, but you will add up a whole lot more, so you'll end up benefiting, you'll end up getting more marks than you end up losing. So that's very important. The other thing, as I said right at the beginning, follow the method. Fill in your opening balances except for capital and your fixed assets. Those can change during the year, and you will only know how they've changed once you actually read the adjustments. And then just in summary here, anything that is accrued is owing. We haven't paid or received enough, so you're going to add. Anything that's in advance, prepaid expenses or in advance, you're going to subtract because you've received too much rather. Any unused stationery, consumable stores, etc., you're going to subtract those because you're going to use them next year. And then don't forget in your income statement, the figures that don't have opening totals, depreciation, stock deficit or stock surplus, don't forget to record those as expenses in this case here, or if it was a surplus, you record the surplus under other income. Okay guys, that's all for now. I wish you all the best for your end of year exams, and I hope that you do really well. Thanks.